Hello and welcome to Econ Simplified. Have you ever heard of the lost 30 years? It's the story of a powerful country that went from a booming economic powerhouse to decades of stagnation. We're talking about Japan. In the 1980s, Japan was the envy of the world. It was a time of incredible wealth, technological innovation, and a powerful sense of national pride. But this golden era was actually a massive economic bubble, and when it burst, it created a shockwave that changed the country forever. Today, we're going to break down the story of Japan's bubble economy, how it started, why it grew so big, and what happened when it all came crashing down. So, what exactly was going on in the 80s? Imagine a time when everyone felt rich. Stock prices were soaring and the value of land was rising at an unbelievable rate. People believed the party would never end. This was largely fueled by one thing: cheap money. In the mid-1980s, to help Japanese companies export more, the central bank lowered interest rates to almost nothing. This made it very easy for people and companies to borrow huge amounts of money. Where did all that money go? Straight into real estate and the stock market. People were buying up land and houses, convinced the price would always go up. Companies did the same, taking out massive loans to buy property and stocks, creating a cycle of ever-increasing prices. It was a frenzy. The land in Tokyo alone was said to be worth more than all the land in the United States. It was a clear sign of a bubble. A bubble, just like a balloon, can't grow forever. It has to pop eventually. By the late 1980s, the Japanese government saw the danger. They realized the economy was overheating and decided to act. In 1989, the central bank started raising interest rates. This was a classic move to cool down the economy, but it was too little, too late. The cheap money that had fueled the boom suddenly became expensive. The effect was immediate and devastating. The first domino to fall was the stock market. Investors, now needing to pay back their loans, started selling their stocks. This triggered a panic, and the market crashed. Then the real estate market followed. Prices plummeted, and a plot of land that was worth millions one day was almost worthless the next. The value of people's homes and companies' assets evaporated. The aftermath of the burst bubble was the beginning of Japan's lost 30 years. Companies that had borrowed heavily to buy land were now stuck with massive debt and worthless assets. Many went bankrupt. Banks, which had lent all that money, were left with huge piles of bad debt they couldn't collect. This led to a banking crisis. With companies failing and banks in trouble, jobs were lost, and people became afraid to spend money. Consumer spending, which is a major engine of an economy, ground to a halt. The government tried to restart the economy with huge spending programs, but it wasn't enough. The psychological damage was done. The people and businesses of Japan had lost their confidence. So, what can we learn from this? The story of Japan's bubble economy is a powerful lesson about the dangers of excessive speculation and the importance of a stable financial system. It shows that easy money can create a powerful illusion of wealth, but it's not a substitute for genuine economic growth. The Japanese experience reminds us that a financial bubble can have long-lasting effects, impacting not just the economy, but an entire society's mindset. It's a cautionary tale that remains highly relevant today. Thanks for watching. If you found this video helpful, please subscribe to Econ Simplified for more clear explanations of complex topics. See you next time.